What's going on, everybody? Welcome back to the Multifamily Wealth Podcast. This week's episode is a special one. It is number 300 on the podcast feed, and 300 episodes is a lot of episodes. I can't believe that that we've released this many episodes or that I've recorded this many episodes. Frankly, if we didn't number them and I didn't have that hard piece of data to track how many episodes we've released, I don't even think I would guess that we've done this many episodes. But it's a really cool milestone. And we started the podcast back in May of 2020. So we are over 5 years, 5.5 years into doing the podcast fairly consistently, might I add. I think that there was stretches of time where maybe we were going from weekly to bi-weekly, stretches of time where I was doing 2 episodes a week. But by and large, we've been pretty consistently around 1 episode a week for 5.5 years. And I think I'm proud of what we've done behind the scenes here to stay on that schedule because it's a grind to put these together. It's fun to record the conversations or to just record my thoughts on the solo episodes, but it's a whole nother thing to actually get them edited and get them produced and get them posted. And I look forward to doing, 300 more, another 5.5 years because I enjoy doing the podcast. But what I wanted to do in this episode is talk about how some things have changed in my world slash our business since I started the podcast. Because I think for me, it was really cool to look at how the business has changed over the last 5 years. And it was a nice trip kind of down memory lane. But I think this will also be helpful for you and the audience and the listeners, primarily just for the perspective on how my thinking has changed around real estate investing, business ownership, etc., over the last 5+ years and over the last 300 episodes. So I think that this is going to be maybe interesting from kind of a summary and how our business has grown. But as I talk about some of the stats and how things have changed in our business, I'm going to share how my thinking around these different things in the business have changed as well. And I think that that's probably going to be helpful for everyone here in terms of just getting exposure into how my thinking has evolved around real estate investing and just growing the Aligned Real Estate Partners real estate business. So let's start at the top here because I'm sure this is going to be a longer episode and I don't really want to drag it out longer than it needs to be. And I want to make this actionable, tactical, and valuable to all of you, as is my goal on every episode of the podcast. And I don't want this one to be any different. So number one, let's talk about how the unit count within the business has grown over the years. And through that lens, I want to talk about how my perspective on unit count as a metric has grown. So even before I talk about launching the podcast in 2020, if I go even before that into 2019, I believe, so early 2019, I started the @Multifamily Wealth Instagram account. And at the time, I started that with no agenda or objective as to how I'd monetize that or as to, what I was hoping to get out of actually running that account. And really that was purely to just post about what I was doing in the real estate business, maybe meet other active investors in my local market, the New Hampshire market. And I just thought, hey, this will be, this is fun. This is an interesting thing to do. I'll post before and after pictures. I'll post some valuable content. Maybe having some level of an audience around what we're doing is going to be helpful at some point in the future. And I grew that to, I don't know, like 5,000, 6,000 followers, and then it started to develop some level of an audience there and started meeting some other folks through that account. And it started to become a little bit of a, valuable networking resource for me. And part of at the time when I was talking about as my goal on that was I had an age-based goal that I look at and cringe kind of now when I think about it. But it was, to get to 150 units by 28 years old, right? I think I started that in like my early 20s. And I laugh at that and I cringe at that, right? Because I think that's a bit of a cringy goal and not really, based in anything other than I just wanted to share that journey about an internal goal that I had. And the reason I cringe at it now is because I think unit count is a stupid metric. Unfortunately, it's really one of the only metrics we have in the real estate world to communicate what we do in our business. So, I'm going to talk about the units that I owned at that time and compare it to now and what the business looks like now, but I'm going to provide some context. And the reason I have this very clear, closure around what it was at the beginning of the podcast was I remember the goal that I had in my Instagram bio when I launched the podcast. And at that time, 42 units is what I personally owned. And even between when I launched the podcast and turning 28 and hitting that goal or whatever, a lot of stuff changed and that became kind of something I took to the wayside. And frankly, I took it out of my Instagram bio quickly anyways, and that wasn't even really something that I cared about. But I started the podcast with a personal portfolio of 42 units. No investors, no partners, no syndications, nothing like that. It was just me doing the Burr method, hustling, finding great deals, financing with private debt, refinancing out. And to fast forward to now, October of 2020, or geez, 2025, excuse me, we currently own 515 units within the portfolio. A good vast majority of those, over 75% of those units, I think my personal portfolio is in the 60s or 70s right now, but the vast majority of those units are deals that I have partners and investors in. Some of them I'm 50-50 with, one joint venture partner. Some of them I own 10-15% of through, co-sponsoring syndications where we have, maybe a 30% promote, 40% promote. So the ownership is varies throughout those units. And I would say that the quality of those units varies, right? We have a lot of those units in, call it nicer higher priced areas in New Hampshire where if we were to sell them, they trade at over 200 a door. And then, for example, we have a building in Florida that we own that's probably an 80, 90K, 100K unit type of building, 48 unit building. And there's just, the ownership percentage is varies, and the fundamental through line between all of these 515 units, whether I own them myself with no partners or whether I own them with partners, is that I am an active asset manager on those. I am a manager on the entity. I'm a GP. I'm the person who's making asset management decisions either alone or alongside somebody else. So these are not like I've raised money and invested it with no say on how things go. The other way that I would describe it is I am a personal guarantor on the debt for all of those 515 units. And if I'm PG in the debt, you better believe that I'm somebody who is involved from an asset management standpoint. So long story short, I'm really proud of that growth, but I think it's important to contextualize that through the lens of, you have to understand that unit count, whenever you're speaking with another investor, with a GP, with whoever, is a frankly asinine metric. And I've used this example in the podcast before, but the guy who owns 30 units himself at 50% LTV in the core of Boston is likely a wealthier guy than the dude who owns 200 units at 75% LTV in Indiana, just using broad analogies. And is probably a wealthier person than the guy who owns 1,000 units where he owns a third of a 30% promote alongside a whole bunch of other, sponsors and a whole slew of LPs in a lower price market like the Midwest or whatever it might be. So for me now, and this is what I'm trying to make actionable, for me now, moving forward in our business, because this wasn't the case over the last few years where we were trying to build our investor base. We were trying to work with new investors on the JV side in terms of partnering with other sponsors. We were trying to grow that door count, not for the vanity metric reasoning, but because we wanted to get deals done, obviously good deals. We wanted to continue raising capital. We wanted to continue working with new partners. We wanted to continue expanding the scope of the business. And now what that's subtly shifting to in our business a little bit more is quality of doors over number of doors. And within those doors, and when I say quality of doors, I mean in areas where the pricing for those units is a little bit higher. I want to be in slightly better areas. I'd rather be buying deals in higher median income areas with, call it, higher median rents. That is all relative to whatever the average might be in a given market. But not pursuing low price like 50K to 75K doors in these markets outside of the home base for us. Did some deals in these markets. I did some deals in Florida, did some deals in Indiana. Like these are not markets I want to go back to because the juice isn't worth the squeeze unless you're buying in like the primo segments of that marketplace where you're accessing a higher quality of resident. That's a little bit easier for us to find at home, just broadly speaking, in terms of what the market is in southern New Hampshire or the greater Boston area once you get up over the New Hampshire border, just speaking broadly, or southern Maine, where we just did our first deal. So for me, it's like we want to be doing deals in those markets that are, one, closer to home, two, a little bit higher price, and three, when we're doing those deals, we want to own a slightly higher equity percentage versus spreading what we do across a far larger number of deals, just fundamentally speaking. So I predict that our growth moving forward is going to be it's not going to be that exponential curve that you see on a lot of companies' growth trajectories, but it's probably going to be more linear. We might go from buying 100 to 175 units a year, which is what we've done over the last few years, to 200 to 250. But that 200, 250, our goal is to maybe buy a slightly higher amount of units and just grow in a linear fashion, but to own a higher percentage of those units that we do end up buying. And for those units to be a little bit higher quality and to require less effort on our part to manage. The other stat that I want to talk about is our number of investors. And when I say number of investors, I mean the number of LPs who have invested in our business. That number went from 0 in 2020, as I mentioned, because we had never worked with any investors before, partners, to 135 individual investors. So these are, not just in terms of investors who have invested multiple times, but actually the unique number of investors that we have in our deals, which is tracked in our investor management platform. And no other reason to share this number other than I'm surprised at that number. Like, it's a really surprising number in our business to actually see that. And there's no goals around that within our business, other than maybe we set some kind of soft KPIs internally in terms of, our goal of repeat investors versus new investors when we launch a deal. And, I want to keep that repeat investor number as high as we can. And I'm proud to say that we have a very significant amount of repeat investors, and not just 2-time investors, but 3, 4, 5-time repeat investors who have invested over the last 3, 4 years in the deals that we've done as we've started raising capital. And that's a number that I'm proud of, right? And I think that's for us internally, like, our goal is, of course, we want to and need to bring new investors into the business. But what I get most excited about is when the investor who invested $50K in a deal a year ago decides to invest $100K in the next deal that we do because they've had such a good experience working with us. And that's happened many times. Equity under management, again, 0 back in 2020 to just under $18 million now, 17.95. And again, a number that we track in our investor management platform. And I'm excluding any of, my personal capital that I've invested in deals. This is purely investor equity that we're managing. I remember back when I started raising capital, I was like, that first year, which was 2021, and we had a couple deals that we were pursuing both in our local market and then out of state. And that was really the first foray into raising money was, all right, how do we just get some LP capital across the door? And, I didn't have any joint venture partnership relationships with any folks who I could co-sponsor a deal with who would bring the capital and I would operate it and we would JV it, in a compliant fashion from a co-GP standpoint. Also didn't really have any passive investors in my network because my entire network was active real estate folks. And then my personal network was a bunch of young folks who just do not invest in real estate. I had some kind of family and friends dollars, but nothing that was going to really do much, nothing that was going to help us scale the business. So I remember that first year, the goal was to raise $1 million, right? And we had a couple of deals under contract that required $2 million. And I was I had a partner on a couple of them, and I was like, if they can raise $1 million, I can raise $1 million. We can get these deals done, and we'll start raising money for real estate. And that first $1 million, that first $2 million, kind of those first multiple 7 figures as a real estate operator are by far the hardest to raise because you have no proof of concept, you have no track record, you have nothing to show anybody. And the only thing that made it easier for me was I had a pretty extensive personal track record of buying these 2 to 10 unit deals in the market of which I wanted to raise capital for. And I had very clear proof of concepts in that respect, but I had no proof of concept on working with investors. So that was the only way that we actually raised any money. And that was it. And then it was this Instagram account that I had where I had a few thousand followers and some sense of, and folks being on there and having some sense of confidence, I should say, around my competence and ability to do what we were doing. And that kind of helped get the first kind of few new investors over the finish line. And there was a few lucky breaks. If you've listened to the podcast forever, you've probably heard me telling the story about how I met truly my first LP and who's become a very significant capital partner within our business and somebody who I've done a lot of work with over the years, TJ Burns of Burns Capital Partners. Chance encounter of him finding me losing my wallet on the side of the road, him finding my wallet, reaching out to me, seeing my Instagram account, and 9 months later investing in our deal, and a few years later being somebody who I'm co-sponsoring a fund with. There was some lucky breaks, right? But I would say that the through line in terms of what enabled us to start raising money to begin with was having a track record to reference of my own deals that I did myself. 2, being very cognizant of just building the top of the funnel and telling the story on Instagram. That was the platform at the time. And then starting the podcast, that was also really helpful originally as well. And three was just trying to bring some folks in who could help me raise the money, like co-sponsor deals and having them bring some of their dollars, because that allowed me to just get some of those deals on a contract with investor equity to then go and use to reference in conversations with future LPs as well, and above and beyond just my own LPs that I was working with. So that's been absolutely massive growth. And now we're starting to that flywheel is starting to kind of spin a little bit more quickly now, where we can leverage our past investors for capital as we go full cycle on deals, as we send great investor updates on the deals that we haven't executed a capital event on, starting to get some referrals, and we're starting to really develop a track record that is starting to answer a lot of those questions with the investors we speak with. The number of markets that we invested in went from 1 in 2020 when we launched the podcast 300 episodes ago, that one being New Hampshire, to 4. And we got up to 5 at one point, but currently 4, where New Hampshire is still 90% of what we do. But we just closed a deal in southern Maine, up over the New Hampshire border in Berwick, Maine. We own a deal down in Providence, Rhode Island. And, we've pursued a handful of deals there. And we still have a deal in Central Florida. But we got up to doing 3 deals in Central Florida. And that was really a market that we had a little bit more of a presence in before we decided to sell a couple of the deals that we bought, which went extremely well for our LPs. And we're about to sell our 3rd deal down there, which will be our last one in Florida for now. But part of the reasoning, and again, part of the thought process around this, is shiny object syndrome, like many people had in 2021, where they were chasing Sunbelt deals or chasing deals in other markets that seemed to be higher growth, or I should say were higher growth or are higher growth, but also came with more competition, compressed cap rates, supply challenges, etc. We want it to be a multi-market company where we're doing deals in a number of different markets. And this is maybe one of the biggest things that I've changed my mind about over the last few years, is no longer wanting to be a company that is, in 3 different markets, which I remember in 2021, that was the goal. We're going to do deals in New England and New Hampshire. We're going to do deals down in Central Florida and Southern Florida. And we're going to do deals in the Midwest. And we did deals in 2 other markets, in Indianapolis and Southern Florida at the time. And the Florida deals went great. The Indianapolis deal did not go great for some reasons. We had a lot of insurance challenges there, a lot of, the whole bunch of unique challenges to that particular deal. But I looked back, and one of my biggest regrets over the last 5 years is all of the effort, dollars, energy, whatever, that I dedicated to doing deals outside of New Hampshire, like the backyard stomping grounds, was wasted. It was just stupid. We would have been 5 times farther down the road if I had taken all of that energy in 21 and just poured it into going deeper in a narrow area in New Hampshire and continuing to build out our presence there. Why is that? We had deeper relationships, had better knowledge of the market. We had, by that time, started our property management company and brought everything in-house, which I'll get to in a moment. That market was just a more resilient market throughout 23 and 24 and throughout this year, from a rent growth standpoint, from a value standpoint. We had deeper lending connections. We had deeper equity relationships. It was easier for us to raise money. Like, the whole thing in real estate or in any business is when things start to get easy, that's when you really want to go hard. And things had gotten easy in New Hampshire, and I kind of put it on autopilot, and we're doing deals in New Hampshire while I'm pursuing stuff out of state. But I was grinding to get deals done out of state for reasons that I didn't even really consider at the time, other than just that's where growth is going. That's where other people are doing deals. I should go there as well, which is not sound analysis, right? It was just FOMO, it was shiny object syndrome. I do feel a little lucky in that I didn't get severe shiny object syndrome and start going after short-term rentals or storage or other asset classes. At least I stayed pretty focused to multifamily, but I should have just went so deep in New Hampshire, and we would have had 500, 600, 700 units in New Hampshire versus the few hundred, or well, now it's 400 and change that we have now. But we would have just had a larger percentage of equity in those deals because all of our New Hampshire deals have crushed over that period of time. Not that our out-of-state deals have done poorly. It's just they didn't do as well, comparatively speaking. So if I'm going to really communicate anything to anybody in terms of what I've learned over the last few years, it's when you really start to get good at a strategy, or you start to develop really deep connections and expertise in a given area, a given market, or given asset class, like pour gas on that fire because that's where your truly outsized returns are going to come. And it takes forever to get to that point. So once you do, you shouldn't just, you shouldn't take that for granted. PM company. Right when we launched the podcast, myself and the two founding partners of our property management company in New Hampshire had like just started to sketch out what that was going to look like. And I'll specifically shout out my operational partner in that business, Ryan Weiss, who's in the office running that business on a day-to-day basis and really managing the whole team we have at Blue Door Living, which is our property management company. We hadn't even launched it yet, right? And later that year in 2020, I believe is when we officially launched. It was fall of 2020. We launched with a few third-party units, like 20 units, and then my own personal units, which was like 50 at the time. So we launched with like 7 units and Ryan in the office. And over the last 5 years, that business has grown exponentially. We've gone from one employee, which was just Ryan, being an employee slash owner of the business, to now a team of, I believe, 22 employees as of right now. I think we're right around 8 employees virtually and 14 employees, in New Hampshire, including our maintenance team plus in-office property management related staff. I mean, it's become a real business. We went from that 70 units to now over 800 units under management. Most of that is third-party real estate. Right around 300 units is stuff that I control and own. The difference between that 300 and the 515 from a unit count standpoint is a lot of deals that I own with other sponsors whose management companies actually manage those units within their infrastructure. But within our PM company of Blue Door, we just crossed 800 units. We're adding another 50 units likely by the end of the year. And we're on a roadmap to eclipse 1,000 probably by the end of 2026, which makes us one of the larger third-party management companies in the Southern New Hampshire region. And I don't take a lot of that credit. Like I've just been behind the scenes in an advisory capacity and helping to drive the third-party management portfolio from a sales standpoint, obviously bringing more of my units to the business through deals that I personally close and then close within our syndicated entities. And really, Ryan is the one who deserves the credit for growing that business. We've just been behind the scenes, but it's still, nevertheless, it's been really cool to watch that business grow over the last 5 years into what we believe is like one of the, best, if not the best third-party management company in New Hampshire, where we do a lot of things extremely well, specifically as it relates to managing small scattered site multifamily properties. Internally, the team at Aligned Real Estate Partners has grown from 0, or maybe I'm going to include myself as 1, right? But I was a solopreneur when I launched the podcast, to 5 full-time folks. We have my acquisitions manager, Justin, who is truly running our pipeline, of which I support where I can, and helping us to just bring deals into the business, get them under contract, get them closed. We have 3 virtual team members who are helping with our asset management, our email marketing, our podcast production and content creation, and then various administrative work. And it's likely that we'll bring on a director of operations or somebody in a operations manager level role at some point in 2026, who's going to be based in Southern New Hampshire and who's going to just drive and walk our properties and stay on top of our third-party management team, or I should say our in-house management team. And that's been really cool to see the business grow both in the investment business, right, which is what I call the Aligned Real Estate Partners business. Again, something that I've really noticed here, and this is going to deviate from team a little bit, but it's relevant. If you had asked me in 2020 like what I wanted the Aligned Real Estate Partners business to be, I would have said we want to own 3,000 units, 5,000 units in multiple markets throughout the country with a really large team, right? Because you need a large team to run a business like that. If you want to own and operate 3,000 to 5,000 units, you're going to need asset managers. You're going to need investor relations. You're going to need office managers. You're going to need folks on the acquisition side. You're going to need all kinds of virtual folks to help with underwriting, to help with administrative work, content creation, marketing, etc. A team of 10, 15, 20 people. And what I've since come to realize is that the more ideal business to pursue from an end goal standpoint is one that's 1,000, 1,500 units in size, but where we have a larger chunk of equity in those particular deals and where the team is a little bit more streamlined and where it's a little bit easier to actually operate and run the business. And I remember speaking with another investor who had done both, right? They had run what in their words they described as like a deal shop, like a whole bunch of like motivated folks pursuing deals and getting stuff done. They owned a couple thousand units. I think their office was like seven deep. It was a couple of operations folk, acquisitions folks, investor relations person. And they took that business from a couple, 1,500, couple thousand units all the way to like a 10,000 plus unit business that employed like 30, 35 people outside of the PM business, right? That's just purely on the investor, or I should say on the investments business. And he's like, it's just a very different business, right? You go from being a deal shop where you get a whole bunch of high agency individuals who want to, kind of run and gun, to what's a much more bureaucratic corporate business where you are no longer extremely lean and nimble, but to where just through the sense of scaling or just, through the process of scaling, you have to implement all kinds of processes and safeguards and approval functions, right? Like a deal needs to be taken to, or a deal goes through acquisitions, it's under it and it's taken to a manager and then it's taken to investment committee and then there's an offer made and then the capital's gone out and raised. And it's just not a nimble business, right? And for him, he goes, I went from being like the deals guy to being a manager, which is just a very different role. And for me, at this point in our business growth, I don't really think that that's like a shift that I have a significant desire to make right now. And I think that we can still saturate our market in New Hampshire with a more lean team. And that's the other piece of this as well is if you want to get to a business that owns and operates, call it just for numbers, 3,000 units, you can't do that in a small area, like from a geographic standpoint, from a population count standpoint, small metro. Like even if you're in Dallas and you want to be in the DFW area, to own and operate 3,000 units that's a tall order, right? You can do it because it's a big market with a million plus, I'm just guessing, I'm assuming, right? Probably multiple million plus in that metro, at least 1 million plus. And you have that ability, right? But it's still probably challenging to do so, specifically in that one particular region. But if you're in an area like Southern New Hampshire, which is like very broad, very broadly speaking, like a 500 to 700,000 population region, it's really hard to get to that unit count. If you get to 1,000, 1,500 units, like you're starting to own a pretty large percentage of the available, rental stock there relative to having the same goals in a larger metro. So for us, we've kind of recalibrated our goals around what's available in our marketplace and getting to a business that owns and operates 1,000, 1,500 units in-house, I think is an admirable goal and a sizable business and allows us to strike a nice balance between lean team that's high agency, that is not bureaucratic, that's very startup kind of culture feel, while also providing our LPs with plenty of opportunity to invest, while also being able to manage it in-house effectively and to continue buying good deals, right? Because again, unit count goals, if you're going to aggressively pursue them, you have to buy good deals fundamentally, right? That's step one. You can't just buy any deals or else you're just going to run yourself out of business. So if we can buy a few hundred units a year and those are quality deals and we have that ability, that's really what we want to run as a business. And that's kind of how my thinking has evolved on that topic over the years. The last metric that I'll mention before I close out this episode, the podcast downloads, right? Just how big has the podcast got? We obviously went from 0 when we launched to over 450,000 lifetime downloads for the podcast. And that's cumulative for all of our episodes. And I'm still very proud of like the audience that the podcast has in that it's a lot of folks who listen to every, most of, if not every episode, who are in the game, like doing deals and who are transacting, right? I think the natural content that we discuss on this podcast is much more tactical. It's much more tactically geared and actionable than it is like kind of mindset or like general or high level. Like I think we get into the weeds on this podcast, and I think the audience are folks who really appreciate that and like to listen to what we do tactically speaking in the business. And I oftentimes have struggled with the idea that like being a little bit more focused on catering to new folks, right? How to do your first deal type content. When you think about like what the Bigger Pockets podcast has become, it's very much a show where they just want to get folks from 0 to a 1 deal. And I think that there's a place for that content, obviously, right? I mean, there's a lot of folks who just want to buy their first duplex. That's not really the audience, I think, for this show. I think this show really consists of people who have portfolios, who want to figure out how to optimize the portfolio they have, how to scale their business, how to do bigger deals, how to start raising money. Stuff that isn't really applicable to somebody who wants to go from 0 deals to 1 deal or to go, figure out how to buy a condo and rent it out. Like that's not really our audience. which is too bad because if I catered the content to those types of folks, it would just be a much larger listener base because there's more folks to speak to. You know, there's more folks that fall into that umbrella than the folks who are like, I own 25 units and I want to get to 100 in the next couple of years or whatever the situation might be. So I don't plan to change the content of the podcast. I enjoy having more tactical and in-depth and kind of deep conversations with the folks who I bring on the show. But I'm really proud of that downloads number given kind of the content that we discuss. You know, I think we're typically around 1,000 folks an episode, which I have no idea how that compares in the grand scheme of podcasts and what people do, because I don't really talk to many other podcasters about like the download numbers they get. I know it's pretty good because I know of a lot of folks who are getting, you know, low numbers, but the folks who have been doing a podcast for as long as I have, which is an extremely small number of people, don't really know how it compares, don't really care, because when I visualize 1,000 people in a room, it's obviously a large number of individuals, right? And I feel pretty lucky to have a platform here that we've grown over a long period of time to where I can speak to that number of folks. And my goal is to continue growing it because I do think that this podcast has really helped a lot of people because they've reached out and told me, right? It's because it's just due to feedback in terms of helping people get from, you know, a few deals to like working with a partner or raising money from a couple of guys or starting to do some direct mail marketing and actually growing their business in a real meaningful capacity that's outside of the norm of I'm just going to go and try to pursue those broker deals and throw a huge chunk of cash out and hope I get it out and the market helps me in a few years. And that's something that I'm really proud of. So with that being said, I think by the time this goes up, I don't think we're going to have reached 300 reviews on the podcast and ratings, although maybe we have, right? Maybe I'm shortchanging myself and we will have reached it. I think we're at like 297 or 8 at the time that I'm recording this. But if you are someone who has listened over the years, I know I ask every week, but take the 2 seconds to scroll down in your iTunes app and just click 5 stars. That's how the show grows, right? That's how we organically grow, which is really hard for a podcast to grow. You know, most podcasts are growing linearly based on the host's social presence, right? That's fundamentally how podcasts grow. You got a big email list, you got a big Instagram following, you got a big whatever following. You know, we'll go listen to your podcast. It's really hard for podcasts to grow organically. And the only way that we can do that is by adding reviews. Outside of that, if there's any recent episodes that you really got some value out of, my one ask again, go out there and just text it, email it, share it, however you want to share it with somebody in your network. Tell them to subscribe to the feed if they are in multifamily. We have a number of episodes coming up over the next few weeks that are like some of my favorite episodes that I've recorded. We've got one next week. I believe this is going to be next week's episode with a couple of guys out in Utah who have rapidly grown a portfolio, who share a couple of great stories around the deals they've done. And I think that's an episode that's like both entertaining and tactical. And I think that's going to be one that many of the folks really love to listen to. So be sure to subscribe, be sure to leave a rating, be sure to share this show with folks in your world if you think that they're getting something out of it. But again, I appreciate all of you for listening over the years. I look forward to doing 300 more in 5 years, more of hosting the show. And I'll catch you guys on the next episode here. Thanks again.